In this video, we'll discuss about market-linked CD, also known as MLCD, and we'll derive the rate of return of MLCD. And we will also discuss about MLCD with guaranteed return. Similarly, we will derive the return rate of the MLCD with guaranteed return. In the normal CD, the investor will give the bank, let's say $1, and then at some time in the future, the investor will get back the $1 plus the risk-free return. In the case of MLCD, the investor will initially give the bank $1, and then in the future, the investor expects to get back the $1. Notice that this time is a little bit different. The bank doesn't have to give the risk-free return to the investor. Therefore, the bank is as if it has got extra money of RF. And when we calculate the amount of RF in terms of present value, then we get this. So with this present value of money, the bank can purchase some index call which will return some form of profit back to the investor in the future. With the present value, let's find out how many units of the call option that the bank can buy. Let C be the at the money call option cost. With this amount of money, the bank can buy 1 unit of the at the money call option. And in this case, we have this amount of present value. So the bank can buy this present value divided by C to get the number of units of the at the money call option. Having this amount of call option in the future, let's say the stock price at time T is greater than the stock price at the present moment. In this case, the investor will get the profit of number of units of the call option multiplied by the increase in the stock price. But let's say the stock price is equal or less than the present price, then the investor will get nothing out of the index call. Next, we'll derive the MLCD rate of return. The market rate of return is denoted by RM, and it is equal to the stock price in the future divided by the present price, and then minus 1. For the case when there is a decline in stock price in the future, the investor will only get back the $1 because the index call won't be exercised. And for the case when there is increase in the stock price, the MLCD rate of return is the $1 plus the amount of return from the call option divided by the initial investment of $1 and then minus 1. And simplifying the algebra, we can arrive at this, and after that we divide by the present value of the stock price, then we will get the market rate of return on this term, and this will be the slope of a linear graph. Therefore, when we plot the MLCD rate of return graph, we will get this kind of graph. So for the market rate of return of negative case, then we will not get any return from the MLCD. And when the market rate of return is positive, then the investor will profit accordingly to the slope. This slope is also known as the participation rate or multiplier. Next, let's look at the case where we have MLCD with guaranteed return of R min. In this case, the investor will give the bank $1 as before, but then later on, the bank has to give back the investor the $1 and the guarantee return of R min. And because the bank has to give this extra amount of money in the future, the bank can buy less units of the call option. Originally, the bank can buy uh this amount of the call option, but because of this R min, we need to subtract out its present value here. Therefore, the bank can only afford this amount of the call option. When the stock price in the future increases, then the investor will get the profit amount of the number of units of the call option multiplied by the increase in the stock price. If there is no increase or if there is a decline in the stock price, then the investor will not get anything out of the index call. Now let's derive the rate of return of the MLCD. For the case when we have a decline in the stock price, then the investor will only get back the $1 and the guarantee return. So in this case, the investor will only get rate of return R min. And let's consider a case when there is an increase in the stock price. The rate of return of the MLCD in this case is the amount of money from the bank and also the amount the investor gets from the index call. And then divided by the initial investment of $1. Finally, we subtract 1. And simplifying the expression, we will arrive at this. And similar to the case before, we will divide by the present stock price to simplify the expression. Then we will arrive at the market rate of return on this term. And again, this is a linear graph. So as I said before, when the market rate of return is negative, the investor will get only the R min. And for the case when the market rate of return is positive, the investor will still get the R min plus the profit from the index call according to the slope here. So that's it for this video. Thanks for watching.